Hey guys, so I'm doing a follow-up in terms of my um, crooked voyage of discovery into the dark, mysterious, voluptuous, sexy or unnerving area of the market that we call volatility, which is having a very unusual. Is it having a very unusual year? That's a prejudice of mine, and I'm really happy to have Benn Eifert of QVR Advisors, I can see behind you, who does quantitative volatility research. Um, and really to help me, Ben, hold my hand and guide me through the corridors of your mind.
It's great to see you, Hugh. This is going to be fun. Is Vol having a weird year? I don't think so at all. I think it's having a year that's a little different than a lot of the years we've had recently. But every the world kind of comes and goes. I mean, I think one really big difference, right, with this year versus say any year in the last 5 or 7 or whatever, right, is that we're actually having kind of a slowish grind down in stocks. We just haven't done that for a while. Why haven't we done that for a while? You can kind of get very theological about that, and there's probably some good reasons for that too, right? But a slow grind down in stocks is a really different dynamic than the slow grind up punctuated by big crashes that then we all rush out and buy and sort of rip back to new highs, right? And that's really, I think, the biggest thing. Every time in the last 10 years that the market's gone down, it's usually gone down in a hurry. And then everybody's gotten, scared briefly and then really excited. And then we all, run out and buy it and make it go back up again. And this time we're not having any big crashes at all. This was sort of in a weird way, kind of like a consensus sell-off, right? Everybody was like, okay, the Fed's going to hike. Okay, stocks are too expensive. Okay, stocks are going to go down. Everybody got lightly positioned. Nobody was super long and super levered. So we didn't fucking crash the market because to crash the market, we got to all decide we're wrong and suddenly try to sell in a hurry, right? And so it's just a different market. Is that weird? No, it's probably more similar to some of the price dynamics in the tech bust 20 years ago than it is more recently, but it's not. It's a thing that the market does. Nothing wrong with that.
Yeah, okay. So if you will, the recession that we are enduring, but which is presently being denied by public officials, is an apparent and real known to the bond market. We can see that in the shape of the curve. So this is the most predictable. We've been here before. We built this volatility machine. We know that periodically the system can get shaken to its core. And therefore it's a grind, and there's a degree of grind because the Fed is supposedly withdrawing its free put option on the market, i.e. saying we're not going to intervene. I suspect the market will, if we're down 25 and you do nothing, fine. What if we're down 35? What if we're down 45? I wanted to ask if there is growing disillusionment in your world, or more pertinently in the world of the people who put the pennies in your machine, the clients that fund these volatility strategies. If there's a growing disenchantment with vol as an asset class.
Oh no, this is exactly, we love this shit, right? Because most years the equity market goes up 20%. And we probably don't make 20%. Hopefully we make something. Maybe we make 10 or more, God knows what. And everybody's like, wait, I had to spend all this time listening to your shit and hear you talk about math and all this stuff. And why do I even do that? Why don't I just own stocks? They just go up, right? Well, it's when the market's down 20 or 25 and we're up 10 that then people are like, oh yeah, that's why, right? I mean, so again, it depends. Lots of people, there's the vol space and the derivative space is really big, and all kind of people do different stuff, right? We run an absolute value relative, market neutral hedge fund is the one big thing we do. We also do some other stuff, but our job in that role is just to have completely different sources of return in what we do than the equity market, right? And we might be down when equities are up, or up when equities are up, or who knows, right? It's supposed to be uncorrelated, and people like uncorrelated obviously a lot more when equity markets are down,
which is very rare. Yeah,
which is rare, right?
Yeah, I get the pushback all the time. This is me again. Just I should let it go. I should just seek karma. But effectively, I ran a strategy similar to what you describe, And my benchmark is not, dopey beta 1 S&P. It is like when it's having a cardiac arrest, I'm making money, but it's very rare. And the challenge for you and I is actually to kind of record something near that. I mean, 10 in the out years, which are the many of the out years, is a fantastic return. You're creating a positive carry. It's an insurance contract which actually pays you. Like you don't pay for it. If you do it properly, the client is receiving an insurance contract which pays them. For me, I think I generated on average 8% per year. You're quoting 10. And then in those outlandishly dangerous environments where it all comes apart, boom, you would probably, I would expect, you'd be hoping your ambition would be to make more than 10 in those years. Yeah. You'd be seeking a convex return in those.
That's the hope. And in absolute return, it's not tail hedging. So we're not explicitly going out there and buying just shit tons of put options and being short the market or anything. So there's no guarantees, but the whole driver of alpha in absolute return and derivatives is dislocations in the market and just things that don't make sense. And when the world's full of chaos, like there's more stuff that doesn't make sense, right? So as long as we do a good job and don't get too unlucky, like we're going to find more stuff to do. There's going to be more good opportunities. So 2020 was a monster year for us. Again, not because we were just like buying tons of tail hedges and waiting for that to work, but just because there were such generationally good trades out there if you were in a position of strength and knew what to do in our markets in 2020. So we were up 78% or something. But then the markets bounced back really hard and we kind of kept making money and doing well for the last, few years, and we're doing well in this market. So I think that's the thing with our investor base is, again, we're never going to keep up in just like the boring 20 or 30% up year in the equity markets. Like it's not our benchmark and it's not our, not something that's our job. 2017 is a pretty boring year when just everything melts up in a straight line with no volatility or whatever. So we're going to be maybe we'll be flat in a year like that. That's okay. Hopefully it doesn't happen too often.
Yeah. So the grind of this year, the predictability of this year has to be noted. And I was hoping that we could compare and contrast that year where you made 78%, with where we are and whether there are fault lines or we can anticipate just further grind. When it's not a grind, and I have to commend you for the returns in 2020, because I would imagine like you could have 100 million Delta 1 short or long position, but in the environment of March 2000, I don't think you would know what your exposure is. It would be moving so insane. So could we maybe go back to that period? I mean, that period, I want to say we'll never see again because, with the pandemic, you had, a popular strategy is the dividend strategy, especially in places like Europe. And then suddenly everyone's locked down, boards are not going to be meeting, profits are going to zero, our company's going to pay dividend. There's so much you didn't know. And your ability to hedge in that environment is disappearing. And so you can see why March of that year was especially acute and why it's not really a benchmark, one would think, in looking at a year like today. But could you just say something about, so I spoke with Jen Carson, and unfortunately his mic wasn't as good as yours. And may I commend you because you look a bit like Keanu Reeves. I think you're in the Matrix there, like the chair. It's all very
take care of business.
And I'm sure I'm doing an injustice, but I got the impression so March is a big quarterly expiration on the third Monday of that time. There'd been a minor expiration in February. The pandemic fears had been known, and people, knowledgeable people were kind of protecting themselves. There was probably profits which were closed out. So my impression from what Jen was saying was that the market, the people who sell, found themselves a little bit out, and they had a lot of kind of delta hedging to do. which effectively would be shorting stocks against their book. And so it became a kind of, there are times when the vol market can become reflexive and create another wave of selling on top of a market that is pressurized to go down. Could you maybe just clarify and help me understand perhaps what Jen was saying?
Sure. And like, I'll come at it from a different angle because I think we probably think about different markets a little bit, but I'll give you the one of the kinds of examples that, you know, we pay a lot of attention to and we're really focused on. So there, you probably know what, if you remember what a variance swap is, it's a terrifying and not actually very complicated thing. A variance swap is this idea that you do a trade that has a start date and an end date, and you're going to count up what is realized volatility over that period. So, you know, what are the squared returns of the thing, and you're going to square it, because why would you have a little bit of losses when you could have a lot of losses? And then you're going to either buy it or sell the thing. And if you're a knucklehead that likes making a little bit of money most of the time, and then every once in a while, you know, get it going to fucking Armageddon, then you sell variance swaps, right?
Yeah.
And so it'd been a long time since anything really particularly bad and crazy and volatile happened in the world for any extended period of time. So there were a lot of people who really liked to sell variance swaps and sell things related to variance swaps that are even scarier, that are like, you know, a call option on a variance swap, or like all kind of shit like that, right? So what happens when you get into a really volatile situation, like in March 2020? So the banks and the market makers are on the other side of that stuff. And what they end up having to do, they replicate the kind of the risk of that with a big strip of options in some kind of complicated way. And what it turns into is the dealers are rehedging the short gamma for those clients. In other words, market's down a whole lot, and the positions, the way you rehedge them is you got to sell a whole bunch of stocks. And every time there's another big move, you got to do that. And then, by the way, tomorrow, if it rallies 10%, then you got to go buy it on the close. Right. So you remember, not only were we having huge swings, also, you remember we'd be like, the market be down 7% and you'd hit the market on close, and you just the market on close would be some big number with shit liquidity. And then we'd be down 10%, and then we'd be down 12%. And you'd get like a huge, and that was those guys coming in and being like, I just have a market on close order for $10 billion to sell. And I don't care. I'm a dealer. I'm hedged here. I'm just matching the close. But just the sizes in the liquidity context are massive, right? And so now all those guys that used to like to do that stuff, they all died. And now investors know, but now anybody asks a vol manager or any manager that trades derivatives, they say, do you short uncapped variance swaps? That's like on their list of questions. They didn't used to know about that. They didn't used to ask that question. It's good. They've learned, right? So that's, you know, within my little part of the world, you know, that was one huge mechanism. And that didn't cause the sell-off, but that certainly amplified and extended it, and to your point, created this reflexivity effect.
Forgive me, I'm looking for my jellies, which relax me. I can't find them.
Variance swaps get me fucking excited too.
Okay, so like you say, going into early 2020, the world had been kind of humdrum. That, you know, the last event had been a kind of modest deval out of China in 2015. We'd seen Jay try to raise rates a little bit and then capitulate when we had a spike, and the S&P was down 20, and it was over and done with very, very rapidly. And so it bred complacency, and you had these variance swaps. When you said the market comes in with that market, sorry, the trader comes in with that market order on close, and he kind of doesn't care. Is he hedging the client, or is he hedging his book? Because if he's hedging his book, he kind of cares, no?
It's because he's got a variance swap facing the client, and that variance swap is going to fix at whatever the closing print is, and that's going to determine the P&L. And so for his hedge, all he wants to do is match that. And he's got to do the hedge on his fixed strike book that's hedging that exposure that's facing the client. And so he's going to rehedge that. And that hedge is going to, you know, if there's enough people doing that in enough size, that might move the market 4% in the last 10 minutes of the day. But he's got the variance swap on that's giving him the benefit of that too, and it just nets out. And so he doesn't care. And, you know, yes, he could be trying to do, right? So you could hedge an exposure like that. If you just had the fixed strike leg, you could be like, well, I'm going to slowly algorithmically work it for 2 hours to get better liquidity. He doesn't want to do that because his variance swap doesn't do that. That's facing the client. The variance swap counts the daily close to close return, and that's what the exposure is to. So he just wants to do exactly the same thing on the other side.
Got it. And so then the risk event that was COVID would have dampened the enthusiasm for that kind of
a little bit.
Killed people. And so they're not really in the market anymore. There's recent history, that hasn't been forgotten just yet.
Yep, it'll come back one day because everything does, but they're gone for now.
Yeah. Again, my understanding was that there is some disillusionment about vol in general, owing to its performance over 4 or 5 years, and the gappy nature of it. It gaps in both directions. The ability to get liquidity either side of it, hedging is like, do I really need it? And again, borrowing from, and forgive me, I'm just borrowing from the last conversation with Jem. But is it true to say that there's been this has been a really bad year for the vol managers, big redemptions, yes, there's been a grind, but the last 4 or 5 years, not for you, but for the participants trying to emulate you, have been mediocre, and therefore there's just not. So what I want to get at is that, have we taken out a core constituency of the market? And I'm thinking with a parallel to short selling. So a short selling function in markets going down actually provides a robustness, like an automatic stabilizer, because it will generate profits for the delta long short. And at some point, those girls will wish to book that. When they book it, they become buyers, not sellers of stocks. And that can put a floor, it can take extremes away. Is anything of that nature happening this year? Are you seeing anything of that nature?
That's a good question. I think that it's really hard to benchmark the space because, it's hard to benchmark any space, honestly. But in vol, there's so much different stuff going on. There's the indexes really suck. I would say the marquee brand name players in what I would consider vol and derivatives are having a fine, perfectly good year. I don't think anybody's up 50% or anything, but it's actually not. There's any of the people I'm thinking of anyway. But generally performance is pretty good. I think you're probably alluding. There's definitely different flavors of all this stuff, right? There's kind of relative value, absolute return people whose job is just to make money, and they're broadly speaking doing well, and have done reasonable the last 5 years. They're at least the well-known marquee people. There's the long vol. Kind of diversified long vol community that's sort of out there trying to say, well, we're going to break even or make a little money most of the time and then make a lot of money when the market goes down. And then that really just depends. There's huge dispersion in performance. So people that do a lot of non-equity stuff have crushed it, right? So guys who came in long a lot of rates vol. I mean, look at rates. This is a 3-generational experience of chaos in the rates market. And rates vol is hit levels that didn't even hit in 2008, right? Whereas equity, it's been much quieter.
Yeah, no, indeed. But just to clarify that, because again, I may have a cloudy mind. I thought you may not be referring to this, but when you said rate vol, I kind of come to what is it? The ICE move index fixed income vol, and it's elevated, but it's probably half the wise that we've historically seen. I mean, it feels high, but it's half what it can be in extreme. Or you clarified your point. You said rates in particular. Just want to clear that up.
Yeah, I'm thinking, for example, longer dated swaption vol, like a 1 year into 10 year at the money, payer receiver swaption, for example, would be hitting 2008 levels, and through it. I think it depends on what you're looking at. I mean, certainly, I don't know if there's any indexes on gilt, vol, but those would be twice as high as they ever had. Right? 50 basis point swings in the 30-year gilt, stuff like that. So certainly realized vol in fixed income. And if you compare that to equity, there are pockets of the equity market, the really the crazy venture-backed, software startup stuff that's been really, really volatile. But like you look at the S&P or major equity indices, they've had decent ranges. They've been down 20 or 25% year to date, but realized vol's never been high. We haven't had I think the biggest sell-off days we've had are like 3-4% or something, right? So it's, if you were to compare the the experience in March of 2020, which was really the largest volatility spike event we've had. It was, in terms of short-term volatility spike, was bigger than 2008 in terms of how fast it happened, right? And we were moving 12% a day, and everything was just exploding left, right, and center. This year has just been kind of like a slow dribble.
Can you just? I think we should examine your skill set, especially back then, because given the speed, the alarming speed, that things were moving. How did you stop how did you navigate that? Because you put in an amazing return, and the market. I mean, if the returns, not your returns, but the market dynamics were kind of bookended by those third Mondays between February and March, pretty much, which is such a short turning space. But so can we go back there? How you were positioned, how you managed, what made you change, when you changed, etc. How much of your return was focused in that period? How much came thereafter?
Sure. Yeah. No, I'll take you through it. So we had a couple of main things going on in end of February, early March, kind of coming into all of that mess. So the first thing, we did have one of the biggest dislocations in equity derivatives for a long time had been long dated, really far out of the money downside vol was way too cheap. So long dated skew. That comes from retail structured products where basically, all the French banks, sell their clients notes where they get 10% a year unless the market crashes, and then they get hosed, right? They're more complicated than that, but that's basically how it works. So that just acts like big crash risk selling. And there was endless amounts of that. And so the price of crash risk went down, right? And so guys like us, different people had different kind of trades on. We were long a lot of really deep out of the money, long dated downside, and then short less far out of the money against it on a ratio, so that it's like kind of just a boring market neutral trade unless the market crashes, and then it turns into a giant sort of conditional, long vol exposure that you're having to dynamically hedge on the way down.
So the need for the dynamic hedge, does that mean that in the absence of the dynamic hedge, you face obliteration?
It means that, so if we were not, so the way that it works is with that kind of position, once the market starts gapping down 10% in a day, all of a sudden we're starting to get really long vol and we're starting to get really long delta, right? And you make a bunch of money in a day, and then if you don't hedge it, now your exposure just got a lot bigger, and now you're really directional. And now if it happens again tomorrow, you totally crush it. But if it bounces, then you get hosed, right? So if you dynamically hedge it, you lock in the money you made that day. You sell out some vol, you buy back some of the short delta, and then you see what happens tomorrow. And in our case,
do you use kind of like just dumbass rules? Because, what is the discretion in the dynamic hedging of that? Because they can be a long passage.
Oh, yeah. There totally can be. And for us, so we think that in general, we're really bad at market direction. We have all kinds of opinions because everybody's fucking got opinions, but we're wrong about it usually. And then if we try to reverse psychology ourselves and be like, oh, we think this is what we want to do, so we should do the opposite, that doesn't work either, right? So what we end up doing is just being pretty tight about, at a minimum, full getting back to flat on a daily basis, right? And there'll be some monkeying about what do we do intraday. But at a minimum, we're not going to hold that ton of directional risk that we got from convexity during the day. We're going to flatten it out. And we're going to pick how we're going to
10 minutes. You're not last 10 minutes of the day.
Depends on liquidity conditions and what we've got to do. If there's a whole bunch of all we got to sell, and we trade like market makers. When we trade, we're not out there quoting banks on some big trade and taking liquidity. So we got to work stuff patiently over time. So if we have a ton of all we have to sell, we're going to be working it over hours and stuff. But so that was one aspect. So that, to your point, we rode that position and kept dynamically hedging it all the way down. And then actually everything changed, not at the bottom, but 2 days before the bottom. So the last 2 days of the market, we were down, I think S&P was down 4%. The next day was down 3 or 4, I forget. And both of those days actually vol went down a lot. Yeah, the way that type of trade works, you're loving it until you get that backwards relationship between where stocks are going and where vol's going. Because if stocks go down 4% and you get long a bunch of vol and vol goes down, then you're really pissed off, right? So as soon as that started to happen, we just started to blast out of that position as quickly as we could. We said, look, shit's getting weird. This has worked really well. Let's lock in as much of the money as we can. So that, we didn't sort of top ticket perfectly or whatever. You never do, right? But we managed to hold on to most of the money from that position, and that was probably a quarter of our P&L. So it was good, but it wasn't the big stuff. The biggest stuff.
With that dynamic, the last 2 days, essentially it was kind of big, I don't know, smart or lucky players saying, I've had enough, I'm cashing out. And that activity was expressing itself. And you could see that suddenly the correlation changed. And you're like, okay, thank you. Okay. So
that was exactly it.
So a big speculator had a public utility. He was going, go.
Totally.
Okay, right.
You had like some of the guys, there were some really big institutions that had big tail hedges on that day before, had just come and said, wow, okay, I just made, more money than God on this tail hedge. Like, I'll just sell it at whatever price that it takes. And some of the big banks were, bidding really wide markets and getting hit, 7 vol points below mid, but it didn't matter because the guy just wanted to get out of that size, right? And that's all you could do. So that was that. The other stuff, right? So those were that was big dislocations that we knew about. We had good positions on the way they were supposed to work, right? The other stuff was because, to your point of just how complacent everybody had gotten and how the reflexive behaviors that had been built up by 10 years of nothing ever goes wrong, or if it starts to go wrong, it always bounces back really quick, was that February month end, really weird stuff was starting to happen in the VIX complex. So in the pricing of all the VIX futures and the VIX options. And essentially what was happening was the VIX complex has lots of tourists in it, right? And lots of non-vol arb people, because the whole point of the VIX complex is it's like the easiest way to trade vol if you just have a brokerage account, right? You can go buy a VIX future that embeds this complicated volatility risk, but all you had to do was buy a future. Or if that's too hard, you can buy an ETF that buys a rolling portfolio of futures without knowing anything about it, right? And it turns out that the favorite use of the VIX complex was, over the last several years, was for everybody first to try to short it, and second to, if vol went up, then to really short a lot of it, right? Because everything's just going to bounce back, right? Kind of every time VIX had gone to 40, the last 10 years, within a month or something, it was just kind of back down, and that was pretty close to the highs of where it got. And so, but what happens as a result, when people are trying to sell VIX futures, VIX calls, or ETFs, is you get this extremely inverted term structure of the futures, right? Because VIX spot, that's really vol. That's a 1 month. That's actually the level of a 1 month variance swap is what the calculation is for it. So that's based on where the 1 month options are trading. But when people are trading VIX products, they're not trading that, obviously, right? They're trading futures or something linked to futures based on that. And if they go, and so the front month future with 10 trading days left to go on February month end was trading at 26 when VIX was 41, right? So everybody's like, oh, I got to sell vol. They're not selling 41, they're selling 26, right? And the carry on that, if the world just stays the same and is scary, that 26 carries up to 41 in 11 days, right? So if you're shorting vol, you're actually experiencing a massive negative carry to be short vol, which is all backwards, right? You're supposed to pay carry for vol.
But couldn't you short the future? Couldn't you short the 41?
The futures are 26, right? So if you want to,
I thought you were saying
the index is a 41, and that's
the index is 41.
The index is a 41. The spot.
So you're saying there's 10 days to go to expiration, and the index is pretty much your realized vol of the last X number of days, yeah. The future, of course, is implied, and therefore it's 41. And if I can't trade the 26, I've got to trade the 41, but I can sell the 41 to someone who wants to buy it. No?
So the way it works is you can trade the 26 in a future, right? You could buy or sell the future. The future, the market is implying that 41 number, which is the current price of a variance swap, is going to go down to 26 in 11 days. That's the way to think about what the futures curve is doing. Now you can sell the 41, but that's what that is you have to go out and either sell a variance swap to a bank, which we just talked about that and how that worked out. Or you can sell a bunch of options that sort of approximate a variance swap and deal with that, and that would work out the same, and plus it's more complicated, right? And so the index itself, right, is a bet on realized volatility versus implied. I sold it at 41. What's realized vol going to be over the next month? Turned out realized vol over the next month was 100. Right? So the 41 and your exposure to that is squared, by the way, not linear, because that's why it's a variance swap. So that was really bad too. But if you sold the 26. If just everything stayed the same for 11 days and VIX spot stayed at 41, you're going to lose 15 points, right? Because that 26, you're shorted, it's going to carry up to 41. The other thing that was ridiculous was that you can get into all kind of funky math and stuff, but that 26 was 3 points below like a pure arbitrage boundary with respect to the S&P volatility surface. There's a really strong relationship there. And what that tells you is just somebody is doing something stupid, right? There's an enormous elephant sitting on the future, making it be way, way, way lower than it's supposed to be. And we knew
I've got to ask some stupid questions, forgive me. So that differential of 3, is that a differential to intrinsic, which is just a backhand way of saying actual realized, or as close as damn it to realized, or that it should?
No, much more. It's much more beautiful than that. That's a 3 points below at the money forward volatility in the S&P. Now, what that means is think of an at the money option is going to trade at where it trades, say 20. And that's going to be our best. Think of at the money as kind of reflecting our best guess of what the market's saying about short-term realized vol, right? A variance swap is going to be that plus some premium, because a variance swap has a squared exposure to that. And so you're short convexity with respect to volatility, where if vol goes up a lot, you lose way more money if you're short variance. So in order to be willing to do that, you have to get a premium. And so it might, for example, be normally that, at the money vol is 20 and variance is 23 or 24 or something like that, 3-point premium. So with where things were trading, it was implying that VIX future is like a forward on the VIX, and the VIX is a variance swap calculation. So 3 points below at the money forward meant that the VIX futures were implying that in 11 days at expiration, variance would be trading at a negative 3 point discount to at the money vol. It can't ever do that. That's crazy, because Ben will go and spend every dollar that Ben has buying all of that. And so will all of Ben's friends, and it won't trade there. Maybe it'll go down to 1 or 2 if the world's totally stupid, but it can't go negative. Yeah, because it's sort of massive free convexity and getting paid to own it with no basis risk to anything. And so that was completely wrong. It was obviously completely wrong. We also knew exactly who was putting it there. We knew who the giant guys were that were doing incredibly stupid and or illegal shit.
So without naming them, but what would make them do stupid shit?
Yeah. So actually, one of them wasn't really doing. One of them was very reasonable in a sense. They just weren't very sophisticated. So and this is all public stuff. But so Rougher Asset Management is the biggest participant in the VIX space. They're called 50 Cent, or they used to be when they did this stuff.
Yeah, I know them. I know them.
You know them, right?
Hendry,
and they're great. Totally, and they're great. They just buy 50 Cent, and they don't do this as much anymore.
They're very British.
in the old days, yeah, they used to just buy the 50, whatever VIX calls or 50 cents front month. They buy those. It's a hedge, and it's fine, right? And so they had done that for years. And every time the way it would work out is like there's a vol spike, there's a market sell-off. They'd make a decent amount of money, and then they'd like lose it right away again when the market rallied. So they were like, oh, we need to monetize this, right? We need to lock in some gains, right? So they were out there just, so they had a massive VIX calls position, and they were just selling it at, whatever price, and they didn't care because they just thought, oh, there's another vol spike. We got to lock in the money, right? They gave up, 90+% of their returns sort of doing that. But so that was one huge flow. Then another huge flow was the Allianz structured alpha funds, which if you Google that, if you don't already know about it, you'll find out all kinds of good stuff. There's a bunch of big lawsuits about that. They were just going way off the reservation and trying to make back losses by doing insane shit, right? And by the way, like the way that works is when somebody like that starts doing that, like every big VIX trader on the street is like calling guys like me being like, what the fuck's going on? Do you know what's going on? I don't know what's going on, whatever. Right. So like, there's no anonymity when you're really big and you're doing something wild, which is like, nobody understands that. And it's just the funniest thing. Like, how do you know that? Well, what do you mean? How would you not know that is actually the answer. Right. And then there was a big PM at another big multi-strat hedge fund, which I won't say because they'll get grumpy, who is one of those serial blow-up artist guys who goes to some new place and like sells a shit ton of tail risk and then makes some money for 5 years and then blows up. And he was doing the same thing. So all these guys were just absolutely smashing that particular point on the VIX term structure. Everything was too cheap, but that was way too cheap. And so we have, by the way, everything that we do, I'm talking very qualitatively here, but we have a bunch of different strategies that all have models or whatever. And like the model that tracks this was screaming at us like, this is ridiculous. Like, this is like so far outside how good of a trade this could ever possibly be. Like, you got to look at this. And, we were finding out what was going on. So we put on a really big trade, long that VIX future with 11 days to go and long equity beta against it as a hedge. And so the point
and this is the end of this. This is the third week in February.
This is the last. Actually, it was February month end. Was I think when we put
February month end.
Yeah, and then we managed that position and added to it and cut it and added to it and cut it to it, depending on what was going on for the next couple of weeks. We, carrying up the curve up this crazy VIX curve. Eventually, those VIX futures were like at 80. Those latter two guys, so Allianz and that multi-strat portfolio went up, got liquidated at auction in huge size on the same day in the middle of March. That completely exploded the whole space because the size was so big. And it's like, what price do you have to pay to get somebody to show up in the middle of Armageddon to take down this insane risk, right? And so that took all of that like theoretical cheapness or whatever and actually blew it through to twice as expensive as it had ever been with, ever in history. And so then we flipped out of the rest of that position, got short up at those levels, monetized the recompression of the basis down, and then got out of the position. Right. So that was like a complete.
So all of this is you making and describing rather, kind of cut the. You made 78% for the year. This is you making like what, between 20 and 30% for the year with these trades?
This one was 40. The other one I was talking about was like 18 or 19, I think.
Okay, but I thought you said only about a third of your returns were captured in that kind of February, March period.
Sorry. We made in March, we were up 54, 55, I forget the exact number, something like that, out of 78. So the rest, but that was the important thing, right? So those two things made a ton of money. A few other things made money. Nothing else really materially lost money in March. But then the important thing about absolute return, right, is, then we went and made another 20% or whatever the rest of the year, which you can't do if you're a long vol, if you're a short the market kind of thing. No matter how smart you are, you can't survive a 60% rally or whatever, right? And that's, I think, why, when you look at, people talk to us about managing money for them, and again, they get it. After long runs of equity market always going up 20 or 30%, they're less interested because then it just seems like you can do that, right? But being able to make money from different sources than your traditional risk assets through the market cycle when markets are up or markets are down, like that's kind of the value proposition, right?
Yeah. And so this year, and again, to quote Jean Croissant, are we seeing this tourist or otherwise? But I imagine people where it's not their daily grind like it is for you. And I heard that there was the successful strategy, maybe from generalists, was shorting puts and shorting stocks. Is that right? Shorting puts and shorting stocks, yeah.
In general, if you were short vol and short delta, that worked out pretty well, right? Because it's sort of like vol's gone up, but it hasn't gone up that much. But we've had nice trendy down market, right? So that's been good. And actually, so that same, by the way, I was describing that trade that we did in VIX in March of 20, where we were buying vol and buying delta against it as an absolute return trade. This year, we've just been the opposite way on that, right? Because this year, it's totally the opposite. There's too much risk premium involved given what's going on. And a nice downtrend that has made a short delta position work out pretty well, right? And so that's been, and nowhere near as, the 2020 thing was like 20 standard deviations or whatever, right? Like, so the money involved is not nearly as big, but like that's been a really good type of position to have on. It's been, if you know how to think about these things, it's been the obvious position, and we've had it on. I'm sure other people have had it on too.
Now, are there unintended consequences from the prevalence of the P&L and the position sizing in that strategy, where, I mean, obviously it's predicated on a predictable grind lower, and therefore what's the exposure of something strange, something like very, very severe comes, like we come in over the weekend, China devalues its currency by 15-20% or something
Totally.
absurd like that. Yeah.
Totally. So like somebody like us, and I can't speak to other people, but somebody like us, whenever if we're materially short vol on the short dated VIX futures, we're not just going to do that outright in VIX futures where you have unlimited loss, right? We're going to do it through some combination of different stuff. We're going to use some VIX puts, we're going to use some put spreads on VIX or whatever, so that you got a lot of convexity in that position. And if you have a 20% gap down with sort of like some monster vol spike, which you always have to imagine that you possibly can, even if it's not your likely scenario, right? That you've
but
got
you're long convexity, you're not short convexity. You'd never be short convexity.
If you own like a put spread, if you're structured through a put spread, for example, on the VIX leg, you've just like paid, you're short Vega, you've short vol exposure, but you've just got a fixed amount of premium and an option structure for that. And the worst case scenario is it goes to zero, and you know exactly how much loss that is, and you can do a mix of that and other things. But yeah, generally for us, right? I mean, the most important, we have a pretty simple risk framework. We do lots and lots of complicated risk calculations, but the one thing we do is we have tons of really crazy stress tests, and we can't lose more than 15% in the book to any of them, right? And so if you have down 20% in a day with vol exploding is like one of the stress tests. And if you have a giant short outright VIX futures position, that's not going to survive that stress test. You're going to lose way more than 15%, right? So to be within your risk guidelines, you got to structure it in a convex way.
Okay. So, and what, that's your risk management. What is the kind of the prejudicial risk management that says, this has worked, but maybe we should be kind of looking for avenues different, like the future might be getting a little bit funkier. Maybe we have to kind of reflect that. I mean, how does that work for you?
Yeah, totally. I mean, I think there's a bunch of different things there, but one of the most important is always what kinds of important differences in positioning are there now, and especially ones you can't really see in the data in some way that's one of your models that's going to capture, right? So like sometimes that's easy and sometimes that's hard. I mean, a really good example of that is like back in 2017 and 2018, when the VIX ETNs, and especially the short VIX ETNs like XIV, had become really big, and retail was super excited about being short vol and all this stuff. And you just knew, based on the exact microstructure of how those things worked, the fact that a big VIX ETN that was an inverse, by definition, if vol goes up a lot, it has to go buy a lot of vol and cover its short, same day to get itself back to the right amount of risk. That creates a massive reflexivity, and it acts like kind of short gamma in vol coming into the close, and that looking at some simple historical data on how much could vol spike for a given move in the equity index is wrong, right? Because that's going to break all of that stuff. And that happened exactly the way that, we thought it would and everybody thought it would on February 5th of 2018. That one was kind of obvious because it had been building for so long and we'd all been talking about it for so long, right? Other similar stuff, this takes us back further, but like, we think about skew a lot because we're nerdy derivatives guys, right? You go back to like 2012 in Japan, and a lot of vol people got really excited because skew flipped in the Nikkei and in Japanese equities, where instead of the traditional downside put vols being higher than the upside call vols, it went the other way, where the upside call vols were above, right? And you're kind of
I got so excited.
I believe you got so excited, right? It was really exciting. And like a naive, kind of the stereotypical naive derivatives person says, well, this Z-score is a 4 and it's crazy, and you just have to kind of do the opposite trade because it's going to go back down or whatever. But you got to stop and think for a second, like, why is this happening and who's putting it there, right? As a absolute return derivatives manager, I want to be on the other side of dislocations that are happening because of some kind of price insensitive customer flow or just shit that's happening in the market that doesn't really have a reason. It just is, right? Or a bunch of people that are all doing the same thing and thinking it's a good idea and it's not, or something. I don't want to be on this other side of a bunch of like smart macro guys, right? And what was happening was that Abe was doing, this huge structural change in Japan, and like the Nikkei had been dead for so long, and like macro guys were betting that there could be like a super volatile doubling of the Nikkei, and like that's exactly what happened. So if you sold a bunch of upside gamma, you just got absolutely destroyed, right? And any kind of some naive model of skew where you're just looking at statistics or something would have been like, oh yeah, maybe you want to be short skew. We were like, you absolutely do not want to be short skew, right? So there's an element of that where there's no like data way to do that. That's just like understanding, why is this structural change happening? Is it some random flow thing, or is it like a potentially real macro theme that we have no interest in betting against? And might be right or might be wrong, but like my job is not deciding whether macro guys are right or wrong about stuff. I assume they're right more often than they're not. I want to be like taking the other side of their trades. I want to be on the other side of, random.
I mean, in Japan, they'd been first QE, they'd been first at zero interest rates, and therefore they were the first to have their institutional investors corrupted. And I think the first to really come in and generate income from the volatility. Volatility became an income class. Like you say, they were mindful of just one thing. They had to achieve income, and they were less mindful of the consequences, perhaps, of some of their positions. And therefore, when there was a genuine release of new information with Abe and how it was configured by hedge funds, etc., then boom, that was the risk event.
Totally.
Yeah. And again, just with that, so you talk about it in terms of skew, but another way of saying that was stocks went up and volatility went up, equity volatility. And maybe you could just say that there is no law of nature which stipulates that equity vol can only go up in the event of stocks falling. It's something which has come to the fore, I want to say, after the shock of October 87, and has never really been challenged since then. Could you explore that?
Oh, totally. I mean, and I think it's something that came up again, recently with the whole meme stock rally and huge retail participation, right? Where traditionally we see, especially in equity index, but in general, traditionally we see higher vol to the downside than to the upside in option markets. And that corresponds to how the world works, where usually most of the time stocks kind of go up slowly and crash fast. But that's not like a fundamental law of nature. That's just like how markets often tend to trade in certain environments. When you've got like, take us back to late 2020 and through late 2021. I mean, you remember like SoftBank coming and piling in and buying massive upside calls and call spreads in a bunch of mega cap tech names and lifting offers all across the street and from every market maker. And we were having spot ripping and vol ripping to the upside. And that's a positive skew event, right? And there's no reason that can't happen. The tech bubble back in the 90s was a huge example of that, right? Of very, very volatile rallies and, the right market pricing of skew, at least locally, being, vol to the upside, because that's where stocks are going, and they're going there in a hurry. And probably at some point they'll go down in a volatile way, but not today, right? So that's right. Skew inherently is about spot vol covariance, and how does vol move when spot's going in some way? Are we moving up in a volatile way, down in a volatile way, or what? And there's absolutely no reason why you can't have vol up, spot up dynamics. And this year we've had actually on a fixed strike vol versus spot basis, we've fairly consistently actually have had those positive spot vol covariance dynamics where we've had sell-off days. Actually, I think, so we had a 4% sell-off, which is one of the bigger ones this year, last month, one day. And it was the first time in a long time that I remember fixed strike vol went down on that day on a 4% sell-off, starting from like mid-20s VIX. That's very unusual. Over long periods of time, because usually you get a 4% sell-off. If things aren't already crazy, people get pretty excited about that. 4% is a decent sell-off day, right? We're like, oh shit, gotta buy some puts. Nobody was buying puts that day.
Why?
And everybody's super underpositioned until, right? So the dynamics, I think, of this year are record low, long-term low levels of net leverage and gross leverage among hedge funds. Again, real money investors being underweight equities, and everybody kind of having this telegraphed bearish view on equities. And so what that's meant is actually people only start to get long once we get into these, 5 or however many kind of bear market rallies we've had. And then everybody gets worried they're going to miss it. And then they start trying to chase it, right? And then they get a little bit long, but then they turn and sell it the second that you get a down day. And that's also, also with skew, people haven't been buying downside hedges, again, because they're not long. They're not particularly long. If anything, if they've been buying options, they've been buying upside calls, because what they don't want to happen is for the market to be down 25 and them feeling good because they've been underweight, and then for it to rip back to flat and them to only make 5 or something on that, run back to flat, and have to explain that to their investors. So there's a lot of hedging of the right tail of the rally coming back, right? Again, creating that, bid for upside and that sort of very flat skew.
And I was just thinking through that. If we imagine again, 2020, you have that huge puke to the downside. You're there in the engine room and you can see how it's coming to an end, and you're taking that off. Obviously, there's then the rip to the upside. And I want to say it brings, and so the vol, which was elevated, you mentioned new levels of 100 when we looked at that, the spot versus the future versus the forward. When you said it was, I think, it was 41 and then sliding to 23, I think you said, but 26, but rather than being 41, it traded 100. Yeah. The short squared convexity guys. And then you were, and so I'm trying to join some of these points together. And you were saying the SoftBank guys finally came in. When did they come in with when they were ripping all those calls? That would have been, was that April, May, June? How much later was it?
I think it was, I want to say August, but I'm probably off. It's probably like late July and early August or something like that, I think was the big time period.
And capturing events where you like that, where actually vol then starts getting bid up owing to that activity in the calls. Is that something that you've made money from, like participating? Or are you going, I don't know.
So that was tough. We actually we missed that. It would have been nice to be able to monetize it. The tough thing is I think in hindsight, the trade is like, well, Moss is doing this, and yes, it seems crazy, but he is doing it, and he's so big that he's probably going to keep doing it for a month. So once you see it happen, already the prices are kind of going crazy, but you're supposed to just go that way and ride it to even crazier. That's hard. That's a very idiosyncratic thing to get right. And we just sort of watched it happen and waited for it to stop, and then, figured out what we wanted to do about it. But yeah, I think it was a funny thing, because it's one of those situations where, if you ask, sort of like nobody made money on it. Everybody lost money. Massa ended up losing money. The dealers who he was running over ended up losing money. I didn't make any money. And, somebody effectively did, but, nobody knows who it was.
Have you, there must be kind of pit stories, whatever, emanating from the UK, gilts market, there were no bids that day, prices were on the verge of halving in the British sovereign debt market. Again, created by bad or inept practice, I want to say, via these LDI schemes. I don't even know what LDI stands for. What is that? Loan, where
liability? I think it's liabilities driven investing, I think is what it stands for. I could be wrong.
But effectively, it's just it is profound leverage. It's collateral. Going to a counterpart and saying, I pledge you these assets. Will you give me a ton of leverage? Oh yes, thank you. But there are conditions, and when it started going against them, because I think it's underreported. We're starting to see more and more come out of it. I mean, first of all, financial journalists, I can't beat them up. They don't get paid enough to be beaten up by the likes of us. Right?
That's fair.
The story has been, let's kick the ass of the British government because of their. And again, I'm a little bit. I push back against that, because they dared to have an expansionary policy in a world which is going into a profound collapse.
Yeah.
What should we stay with the status quo? So whatever. But so they haven't reflected on, hold on, these are dull pension schemes that warehouse all the kind of retail risk for everyone at home reading the newspaper. And we've just discovered that they're dealing with cocaine traders and they're leveraged to the wazoo. And actually, there'll be a lot. It looks like they actually pledged a lot of illiquids, and there's a lot of illiquid selling that's now going to come through the system. But I mean, there must have been some heroic or less than heroic tales that came out of that week.
I can only imagine, and I wasn't that close to it. We weren't directly involved, but yeah, the LDI stuff is one of those things where I think that, and again, I'm over my pay grade to some extent, but there's some sort of reasonable ideas there. But then the question is, how is this implemented? How much leverage and using what? And when I see these kind of, generally relatively unsophisticated organizations getting involved in complex derivatives contracts with CSAs where there's big collateral implications, and it's like, here's this overlay. Maybe this overlay even thematically kind of makes sense, but do you understand what's going to happen if there's a huge move in this market and all of a sudden you're called for $20 billion in cash? Where are you going to get that? Do you have the liquidity cushion? And by the way, like, liquidity cushions are something that, everybody woke up in 2008 and didn't have enough cash and was fire selling assets, trying to raise cash to, find the liquidity to deal with what they needed to deal with. There were a lot of lessons learned for a while there. And then a lot of people forgot them because, you see the massive rush into private assets and into pledging every dollar that people have to venture funds and private equity funds with 10-year locks and capital calls and all this stuff. And it's like, the problem is, maybe let's assume that stuff is all really great, wonderful money, good stuff in 10 years. We can argue about that. But you got to have enough money along the whole way to deal with all the shit that might happen. And if you give yourself no margin of error and no margin of safety and liquidity buffer, and then you start doing derivatives overlays that, if they go wrong, could end up with people calling you up and asking you for billions of dollars, you just put yourself in a terrible position. And I think, again, people just unlearned those lessons because it had been so long since a really major disruption.
Yeah, I think it's going to run that story, and just as you were saying that, the big hedge funds that ran into private equity, and where it's 50% of their book, and where the mark, at least the equity book is marked to market. The mark on those private equity books is how you get away with that is insane. And of course,
Totally
there's lockups, so it's not tested by the other side.
And they say, everybody else has it marked there. Like, and you're like, no. You're like, and the public market, and venture is the best there, right? Where you venture in the late stage growth venture stuff, you have a lot of public market comps of stuff that IPO'd or SPAC'd or whatever. And it's like, okay, it's down 90%. So you're telling me you haven't even taken a markdown yet, or you took a 15% markdown. They're like, the public markets are really getting ahead of themselves. Are they?
Yeah. It's like when my kids tell me, but my friend's parents let them do that. I'm like, I ain't your friend's parents. I'm me,
Exactly.
But
That's
anyway,
right.
I'm conscious of the time. There's kind of like just two areas I wanted to pursue before the end. One was effectively the robustness of the underlying architecture of the market. It sounds as if the market feels robust. The position sizing has been lowered. I imagine it's difficult to conceive of anything that would spin this market and where people position on its axis and cause puking or cause reflexive selling into a down market. Sounds from what you're saying, you don't see that. Maybe I'll let you address that.
I think it's all, you always have to imagine that things can get messy because of some external thing that you didn't think about, because that's just how the world works, right? I mean, Putin can get crazy with nukes or God knows what. But from a positioning standpoint, I do think the world is just safer and cleaner than it was like pre-2020. I mean, people that were doing total knucklehead stuff in equity mostly died in 2020. And a lot of them that were doing knucklehead stuff in fixed income or commodities died this year and last year from all the crazy moves. And, there's not that much crazy time bomb stuff. I think the stuff that there is really probably in illiquid credit and private assets and and it's complicated and it's hard to say. I think that the thing about all the private stuff you can make, I think, a very good argument that there's massive markdowns that have to get taken, and there's all kinds of overvaluation. Most of that stuff, though, isn't like linked to levered debt structures for the most part in banks, right? It's sort of like there's a lot of LPs that have fund interests in venture or privates that are marked at, they're up 5x, but they're actually not, and they're going to lose some money. But there isn't an obvious, and that has economic implications and stuff, but it's not like there's going to be banks that fail because of it or something, right? Because that stuff is largely unlevered LP investment capital. The credit stuff and structured credit and private credit, I don't know, we'll see. But I do think, like in equity markets, there's just not all of that crazy weird derivatives time bomb stuff out there that there was in 2020.
Okay, so that's been cleared. And it sounds like it's not your business to then issue profanities about your market direction. Markets will go where they will, and you will seek opportunities within the within the metrics.
Woo way.
So yeah, because I'm wondering if I have to, because I felt from a discursive perspective, as I count up all the number of things that seem to be going wrong simultaneously, or knocking into each other, that I've been expressing a view that I felt more bearish than 2008. But perhaps I've got to rein that back a little bit, because doesn't sound as if there's anything. I mean, okay, there's one thing, a bleak economic set of circumstances, and there's a lot of shocks. If we're talking about the staleness of private equity marks, the World Bank has got Southeast Asian economies outside China accelerating in their GDP growth next year to 5%.
Seems unlikely. Seems unlikely.
And so there's a lot of kind of dumb shit like that. But it's just kind of dumb discursive stuff. It's not, it's not going back to October 87. There's no reflexivity just coming from people doing dumbass things within the markets themselves.
I think there's less, yeah. And I think that relative to 2008, 2008, the excitement was really just how insane the banking system was at the time, and the incredible levels of leverage and this idea that the market will regulate itself and these guys will all just take care of their risk because, shouldn't they take care of the risk or whatever? And, we deal with, historically in derivatives markets, we've dealt with banks a ton, because in the old days to trade derivatives, you had to trade OTC with banks with most things. And I will tell you, starting 7 or 8 years ago, just everything changed. Banks got really boring. We stopped, we don't even trade with banks anymore because they have no risk appetite. They can't warehouse risk. Their regulators won't let them take any risk. Every trade that hits banks, they spray straight out into the interdealer market, regardless of anything. And, prices gap. So the dynamic that you get, I think there really is a lot less systemic risk in the banking system, because they just are, they're supposed to be regulated utilities doing boring stuff and taking no risk. You talk to people who work at banks and they're sort of bored and frustrated because they don't get to do fun stuff. The market implications, there's a lot of gappy air pockets in markets, right? There's a lot of local illiquidity where things just move way more than they used to because there's no market maker that's going to step up to take down that trade at that price, right? It's just going to get sprayed out into the market, into small IDBs, and until kind of the buy side comes out and shops and kind of stabilizes things. So it's like there's a lot more chaos in the day-to-day, machinations of the market. But I think that sort of systemic tail risk of like the levered daisy chain of banks exploding is just much less, because again, they just can't hold all those kinds of crazy positions that they used to.
Yeah, one thing about it, I was listening to you, but I've been expounding upon three shapes of money, three forms of money. There's these bank reserves, the insanity of quantitative either easing or tightening. But that's a pure form of public money, and the Fed's been going around saying, "Hey, take this public Fed money and multiply it." And to your point, banks are like, "Yeah, no, thank you, but no, thank you, no, thank you." And then there's a second form of money, which is the money that the loans that you create, the assets that you seek to have to offset the liabilities of insured, regulated cash deposits onshore. And again, I think that's where you're seeing where in that regulated sphere, Banks are not allowed to warehouse. They're just the risk. We don't want risk. We got the feds up our tail, right? So that's not been happening. But then you've got this crazy offshore scheme with the same banks where when they're invisible and they're unregulated and where, well, the regulation is their reputation with their counterparties, yeah? But you get potentially enormous leverage and it kind of feeds asset price inflation because your money wants to multiply itself. So the only thing that's multiplying is asset prices. That's where it goes. Doesn't, however, sound as if you're seeing any of that behavior. I mean, I guess that behavior is just, I think it's etched in the absolute quantum of asset values versus the GDP.
Yeah, I mean, you certainly saw an incredible run up in asset prices, coming up to the end of last year. And, everybody gets very excited about how much the equity market is down now. And like equity valuations are hard and that's way over my pay grade. But it's like, have things come down from insanely expensive to just slightly less insanely expensive or whatever, right? I mean, I think that there's a lot of different complicated factors going on. But like, you had really just the culmination of 10 years of, again, plentiful, cheap capital, nothing bad really ever happening. Markets just keep rallying, people creating narratives around greater and greater extrapolation of like technological disruption and wealth creation or all of this stuff, and kind of assigning all of these absolutely insane dollar valuations to companies that don't do much, never will have much revenue, whatever, right? On the theory that, well, one of these guys could be the next Google, but like, okay, but there's 200 of them. And like the probability of any of them becoming Google is actually extremely low. And, these numbers just don't make sense. But this was like this huge narrative of euphoria, right? And a decent amount of that has come out, but there's probably plenty more to come.
Yeah. Okay. I get it. I mean, Professor Michael Pettis in China calls that the bezel, that when the banks fund a rise in debt, it can create fictional wealth, and we saw an enormous amount of fictional wealth, totally. which is being discovered now. And so probably if one was a commentator on markets, is like, the good news is there's no shock thing. Bad news is we can probably stay with this kind of, the inertia is just grind until we grind down to, like, we don't have to, the good news, we don't have to gap there, but we probably have to grind more to there. Okay, so there's that. So imagine we get there, wherever there is, but it's, let's say, way below where we are. So my final parting question was, because I can't interview a vol guy and with your intelligence without going back to one of your peers, blue-eyed Chris Cole. He has astonishing blue eyes.
Oh, Chris is great.
He's amazing. And the that paper he wrote, like Volatility at the Edge of the Earth or whatever, where he kind of tried to imagine volatility structures back in 1921. I mean, good, Chris is bonkers, but what an amazing effort.
And we love him for it.
Came back to this notion, which we discussed via Japan and Abe's Three Arrows, where you actually had equity vol and equity direction being positive. Have you tried to conceive or war game like that, an economic environment where perhaps you'd be saying, this shit never really happens, but if it was ever to happen, it could happen in these vexed circumstances? And if so, could you describe vexed circumstances?
I mean, I think we sort of did it, right? In late 2020 through late 2021. It was, pretty dramatic. I think the set of circumstances really was, for the first time in 20 years, we got broad-based retail investors really excited and interested in participating, which they had been dormant for a long time. We got them, not just did we get them interested, we got them into like groups, and we made it a social thing, and we gave them websites and discords and all these things to talk to each other about how they're trading. And we gave them option accounts at Robinhood with big green buttons that sprayed confetti when they lifted the offer to buy call options. And then we gave them daily options where they could buy expiring same day 10 delta calls for a penny, and they could all do it at the same time and smash the market makers straight through their strikes and just like run GME up 10,000% and make hundreds. I know kids around here that made hundreds of millions of dollars on like a $10,000 account and drive fucking Lambos now. Like, that's what happened. We did that. It was wild. It was really fun. We didn't really benefit too directly from that, because it's such a hard thing to trade when you just see this level of like, what the fuck is happening? And I understand it intellectually, but like, the people that I know that did well trading it, as derivatives and vol managers, were people who had done that same thing really well through the tech bubble in the late 90s themselves, and had all of that built-in muscle memory and the ability to see vol go way up and buy it with every hand to the upside and let their deltas run and like smile and pound the table. I didn't have that built-in muscle memory, and a lot of our stuff was defensive. It was like, how do we make sure we don't get hurt by this? How do we watch it and see, right? But
tell me,
that was
so
fun.
with but the only bore is it's GME and it seems idiosyncratic. But did that prevail? To what extent did it prevail with the rise of the Nasdaq bubble, and would that have been a relevant, very potent vol strategy during that period? I don't know, 99 to March 2000.
Oh yeah, absolutely. I mean, if you were long upside, short downside, and letting that ride in Nasdaq and the big mega cap tech names, which were really the names that options traded on. I mean, it was the big 20 companies back then or whatever. That was enormous. You had big spot up, vol up dynamics. It was the same thing where it was kind of a 20s and 30s VIX type of environment, with high vol to the upside, and like you just come in and I was 20 at the time or whatever, but you'd come in and Amazon would just be up 20%. Why? I don't know. It's just up 20%. What the heck, right? Like, and it was very rarely down 20%. And there was a certain generation of derivatives traders and options traders that just came away with that forever, that like you always just buy tons of gamma on everything, because it didn't matter what the option price was. If the stock would just move 30% or 20% the next day, like any vol that you pick, unless it's 5,000, is too cheap. Right.
Okay. So I'm trying to determine or guess at corruption. The corruption of the status quo. Let's say that we grind lower like this for another year, S&P's down 40. What likely would be the corruption whereby people would change behavior? People would say, oh, well, I'm extending this now forward, therefore I am selling, or what? What would that trade be?
I mean, I think that you would start to see, I think along that way, and part of that process will be real like retail and individual capitulation. Right. So I think a lot of the story we've told about positioning and bearishness has been an institutional thing. It was really hedge funds and big asset owners that said, oh, Fed raising rates, blah, 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 right? And like those guys were really light. But retail was just coming off of this euphoria of making money on absolutely anything that they were doing for 2-3 years since the huge waves of retail trading and brokerages and zero commissions and all that stuff happened, right? And so what you saw initially, and actually, by the way, this was the same as the tech bubble and the tech bust in the 90s. There's some good papers on this. Retail was trying to buy the dip and buy the dip and buy the dip and buy the dip and buy the dip for the first year of the tech bust, and have been mostly doing the same thus far for the first 8 months of this.
Yeah, and keeping good old Kathy in a job.
Absolutely. Keeping good old Kathy in a job. And you're just starting to see, I'm going to forget the number of days, but we just had like 10 or 11 days of retail outflows in the aggregate in a row. And that was the first kind of like, is retail capitulating like this last month with this last low? And retail, right, it doesn't behave like, institutions are concentrated. There's really big, fast money people that sell together and trigger each other selling, and they move fast. Retail is much more amorphous, and their conditions and constraints are different. And it's sort of like this amoeba that moves slow and kind of starts to change its behavior and slowly moves, right? And you get and it's very kind of trend following slowly, right? Where like first tries to buy the dip and buy the dip and buy the dip, and then eventually it starts to cascade into selling and panic. And you're starting to the sentiment down the road at the nice public school where my kids go to school or whatever is like all the parents are like, Ben, should I sell my stocks? Like it's so bad out there, like blah 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 blah, blah, right? And this is like the first time. Whereas earlier this year, there was a little nervousness, but it's kind of excitement to buy cheap stocks or something like that, right?
Forgive me. In terms of your community, If we slide another 20% with with vol at those what do we call it, those fixed strikes kind of like doing nothing, will there be a temptation to do something kind of avant-garde, a little bit kind of off-piste?
I'm sure that folks who have been underperforming with the way that they think about the world and trade will, start to try to adjust. And whether they do that, successfully or unsuccessfully, we kind of see, right? It's always tough to change styles. Maybe they'll learn some better tricks. I think that certainly the temptation will get to be to put on more of the positions that have worked this year, right? And look and see what it was that they weren't doing that was working and that they hear that was working, and to do that. And if there's too much of that, then that has its own reflexive impact, right? Because then it changes the price and changes the dynamics, and then you probably want to be on the other side. But I think that we're a small volatility and derivatives, arbitrage and relative value community. It's not that big. We don't.
Yeah, it's not that big until your delta one blows up and your squared convexity, and then you're big.
Then we're big. Exactly. Although a lot of that stuff, some of that stuff was in this community. A lot of stuff's gone away, but a lot of that was big boys. Was not sort of fun little ball managers. There was big pension funds in the Great North doing that kind of stuff. There was
it's the French education system.
The French education system.
They do not encourage the kids to. You've got to sit there and take notes. And how dare you ask a question? Tagul, shut up, But anyway, because my modus operandi is to conceive of contentious narratives that could go on and either form and shape the world as we understand it, become an accepted belief system. But at the time, it's kind of Albert Camus is absurdity in the extreme. I would venture that, again, with my newfound Buddhism, I've now found solace. I found calmness at last. We'll see how long it lasts. I'm an anxiety kind of guy, but I'm abolishing anxiety.
That's a good idea. Anxiety never helped me, so I just decided not to have it.
Well, I had a tough life lesson and discovered nothing is permanent. So I now understand, and I got gratitude from understanding the impermanence of things. And so when I look at the bond market, the US Treasury bond market, the most majestic bull market in history, long in the tooth, and the notion of impermanence has to come to mind. But I believe that both the beginning and the end of that cycle will be marked by absurdity. The absurdity back then was, Fed at 20%, and even with the bond market going, we're having an inversion in here because you guys will not stay at 20%. They were still at 16, which is kind of, if you were looking at inflation was collapsing. Okay, so it was absurd. Yeah. And so I want to wager that we will see an absurd decline in Treasury bond yields back into kind of COVID territory, and that will mark the end. But the environment that takes Treasury yields to there might be a grind, or it might be we might start seeing prices kind of pair off and gap a little bit. And I want to say that the environment that takes yields there will create an intervention. And we talked about 2011, 12, whatever, with AB. It was a government intervention, which kind of changed the mindset of big investors and then suddenly changed the market dynamics and the vol surface, etc. And so I don't think there's any whatever it is, putting your portfolio back to the Fed and it's the buyer until like catastrophic events. But then the Fed does it, and then you want to be long gammon on equities. So you say, well, fuck it. This is Weimar. Anyway, that was why I was leading into some of those questions. But Ben, it's been a delight. It has been a delight.
This has been fun, Hugh. Hey, thanks for roping me in. This has been great.
Your microphone has been profoundly sexy.
Glad you like it.
and wonderful. So you're busy. I'm not. I'm in the Caribbean. I'm gonna go and cut bananas from the trees. I don't know. So
very good. Life is
thank
good.
you.
I'll go chase up some meetings. But no, this was a lot of fun. We'll chat soon.